Let's take a look at the tax consequences of investing with a stock market versus multifamily syndications, because there's a huge difference. And a lot of people don't understand this thing. Sometimes we compare the returns of a stock market with the returns of a multifamily investment. And while the returns may be the same, the tax consequences are drastically different. And it's not an apples to apples comparison. So let's do a quick case study here and let's look at the tax consequences of this, because I think you're going to be surprised. All right, let's look at the stock markets. Okay, on the right, let's say you're investing $1 million, and I'm only picking that amount because we're gonna talk about the same amount for a multifamily syndication. In which case, let's say you're raising $1 million, it doesn't matter. $1 million investment, the return is a 10%, which has been the average of the last 30, 40, whatever, 50 years in the stock market. So you make a 10% return on average, which is $100,000. Now the capital gains is 20%. And that would means that you're paying $20,000 in taxes. So you have a net gain of $80,000, which is a net gain in percentage-wise of 8% on your investment. Okay, so it's pretty standard. Now let's look at multifamily. In order to understand this next example, you have to understand the IRS tax law for real estate in general. There's this thing called the depreciation. And what the IRS allows you to do is to depreciate the value of a building, of any building, any real estate over 27 and a half years, which is a little odd because typical real estate it appreciates, but the IRS says, oh, you know what, it's actually depreciating each year. So you can write off that portion of depreciation as an expense. Now, it's a phantom expense because it's actually, you're not writing a check for it, but you put it on your tax return, so it reduces your taxable income. This is the way it's done. And that's pretty cool. And if you have a rental property, you can certainly benefit from that on your taxes. Now with multifamily, you even get an additional bonus because you can accelerate that depreciation. The tax law allows you, treats different things, different parts of a building differently. For example, carpet might depreciate over 5 years. Electrical wiring might depreciate over 10 years. Nails, wiring, landscaping, personal property, roofing. IRS tax code applies a depreciation for every single item. Now, what we do is for every single property we buy, we order what's called a cost segregation analysis. So, which means that an engineer comes out and they take the entire building and line itemize each particular constituent and ingredient of that and applies a tax code to each one of those and creates a customized blended depreciation schedule that you then hand to your CPA. In so doing, bottom line is you can depreciate up to 90% of a building's value over 7 years. That's pretty amazing. Because what happens is, let's say you invest $100,000 in a deal, and our cash and cash return is at 10%, which is $100,000, which is $10,000 per year. So we're writing you checks every quarter for $2,500. You're going, this is great. When you get your K-1 at the end of the year, which is the document you get for your tax purposes, instead of showing $10,000 taxable gain, you're probably going to show like a $6,000 loss. Why is that? It's because of this accelerated depreciation is so massive in the first 7 years that it offsets your income. Better yet, Donald Trump passed this what's called bonus depreciation, which allows you to depreciate the entire value of the building in year one. We can elect to do that, and that's what we typically do because people who have other passive income passive losses or passive income can use that to offset the losses from this. And if you can't use the passive losses, you just carry those forward until you do. So this is applied to when you, for example, get a sell at the end of when you sell it, you can offset your capital gains with this carry forward capital loss. It's amazing. Bottom line is this: you're not likely to pay taxes on the cash flow distributions you're getting. In fact, you're going to show a taxable loss that carries over. And then at the end, when we make a taxable gain, you're going to pay much, much less taxes, if at all, when we actually sell it for a profit. Very powerful. Let's take a look at a specific example here. I have a building I'm buying for $4 million. Okay, now on the left is the tax code for various different things: the land, the building, the improvements, and the content. And let's assume the value of the land is 20% of the $4 million. Building itself is 50%. The improvements are 10%. The content is 20%. So on the right-hand side, you can. This is, by the way, is all from the CPA, specifically actually from Tom Wheelwright, who wrote the book Tax-Free Wealth. Fantastic resource. If you haven't done it, read it right away. Tom Wheelwright is a genius at dissecting the IRS tax law and pointing out to real estate investors how much money they're leaving on the table. So a lot of stuff is from him here because I've seen him teach a few times. In fact, he's taught for some of our conferences, live events, and our masterminds. Anyway, on the right-hand side is the actual tax deduction per year as a percentage of the value. Okay, so each year, 3.65% of the value associated with the building, just the building, because you can't depreciate the land. Now you can depreciate the improvements in the content, but for the purpose of exercise, we're just focusing on the building, which means that the actual depreciation is going to be higher. We're just trying to keep it a little simple here. Okay, so 3.65% of that is $146,000 as your tax deduction per year. So moving on, your purchase price is $4 million, equity is $1 million, so it's your investment in there. Your debt is $3 million, and your cash on cash return is typically, our target is 10%. So your cash on cash return is $100,000 for that $1 million investment. Remember, we invested in the stock market a little bit earlier. So now you have the same exact return, but your taxation is totally different. Your tax depreciation now, just on the building value of that, is $146,000, which means that you're going to show a taxable loss of $46,000 on a gain of money you're actually putting in your pocket of $100,000. This is what I'm talking about. And if you don't have any passive gains or passive income, now if you do, then you can use that loss to offset that income as well. But if you don't, it just carries forward to subsequent years. Extremely, extremely powerful. Yet another example of why multifamily investments is the best investment on the planet.